Hi, Mark Anderson here, mortgage banker with Paramount Bank. I do lend in all 50 states, so I'd love the opportunity to earn your business. What I wanted to do today was, first and foremost, let you know that rates are a little bit worse today than they were yesterday. And those rates yesterday were a little bit worse than they were the day before. So we've had a week that has not been kind to mortgage interest rates. Now, I thought it would be really interesting and educational to take a look at some bond price charts. I know that's everybody's idea of a rollicking good time, so that's what we're going to do today. This is basically the performance of the mortgage bonds that are where interest rates come from for the end product of the consumer mortgage. This is just a day of activity in the bond market. And I thought it was interesting because it's illustrative of something that we've now seen a couple times. There's news that comes out. The Fed's dropping rates. The Fed is doing quantitative easing. And when those announcements come out, there seems to be a rush toward better bond prices, which again mean lower interest rates. And then that rush quickly settles away. Now, there may be macroeconomic factors that I am not learned enough to understand that maybe that suggests that these types of activities by the Fed are going to take a longer time to really fully bake in. But basically what we see is the news comes out, there's a big peak in mortgage bond prices. It's a positive reaction to that news, but it seems to be very short-lived, and we end up with bond prices falling again fairly quickly. We're now at levels that are worse than what we had yesterday. We're at levels that were worse than where the market opened this morning. And so therefore it's no surprise that rates are headed in the wrong direction for today. Now if we blow up this graph over the last 2 days, this tells an interesting story. It shows you basically graphically when pricing was better and when it got worse. So if we go back to just yesterday morning, it looked much better than it looked this morning. And so that's really why you're seeing worse pricing, because the bond prices have just changed so much over such a short period of time. And anytime that's going to happen, I think a lot of these big institutional lenders, as I've said before in previous videos, they're having maybe some capacity issues, they're having some appetite restriction. And so basically if there's negative stuff going on as far as the bond prices are concerned, it's no surprise that the rates are taking that opportunity to get pushed up. Now if we look at 5 days, we see just how cyclical this can be. We have a pretty sustained period here from the beginning of the day on the 16th. And again, we had some good news that came out that weekend about what the Fed was going to be doing. And we see a big improvement in pricing. And rates were a little bit lower that day. They were 0.375, 0.5% lower than they were on that previous Friday. This impact fell off. We're still at better levels than we had the previous week. There was a decent opportunity right here on the 17th in the early afternoon where we did actually see a couple positive price improvements, and then we see the fall off again. If we look at 1 month, this paints an even more dramatic picture, and it actually shows us when the best time to lock was. The best time to lock and the best pricing that we had was in this interval right here. Around Friday, March the 6th. It was actually a couple days before that, even before the bond prices went up, that we saw some really, really low mortgage rates pop up. And then we see the fall. So after Monday, March 9th, we see a big drop by the 10th, a bigger drop by the 11th, and into the 12th, we ended up in this trough here. Over 3 months, I don't think that's as interesting as actually going really long term. So let's look at 5 years. Actually, let's look longer. Let's look at the last time that the rates dropped to similar levels. Looks like it was in September and October 2012. Now, I remember at that time that the opportunity window seemed to stay open for longer than it did this time. And I'll be interested to maybe take a look at some historical data on why maybe that's my impression of that time. It seems like this time around, the spike in bond prices quickly fell away. And so you had this very brief window where the best pricing was available, and those people that were really decisive locked in and got just incredibly low interest rates versus what we're seeing today. What I hope to do by sharing this last segment of the chart, though, is to indicate that overall, versus certain periods of time in the past, we just have much better mortgage rates than we did in certain intervals in this window here. Basically, if you purchased a home anytime, let's see here, between December of 16 into December of 18, the difference between where the prices were at in this time period versus now, that is going to paint a picture that says to me, you're in a good position to lock on a refinance, because almost certainly your rates in this time period on your purchase, they're going to be higher than what we've got available right now. And so we can boo-hoo about losing maybe on getting the absolute optimal timing right on getting your refinance done. But from a fundamental standpoint, as I said yesterday, if your rate has a 4 in front of it, which it's very likely to, maybe even high 4s in this period of October 2018 or so, it's almost certainly going to be in your interest to refinance at this point in time. So that's what I've got today. I hope this was just a barrel of laughs and a lot of fun looking at this bond price information. If you have any questions, if you'd like me to put together a detailed refinance scenario proposal for you, I'm happy to do that. Just call me or text me at the number below. Thank you very much.